Hello, I'm Professor Congleton, and this is Econ 741, Graduate Public Economics. I'm pre-recording this because I'm going to be away at a conference in Germany next week, and I wanted to have a lecture for you all to take a look at. So there's a block of lecture notes called Lecture Handout or Chapter 4. It's on the website. It's pretty well put together and will include more than I'm going to cover in this segment. So the first part of that lecture you've already had in class. That's about why voters might prefer to have some kinds of services, even private services, provided by their governments rather than by the private sector. This has to do with the effect of tax systems, for the most part, on the cost of private services for a majority of voters. In some cases, if the government is reasonably efficient at producing a private service, progressive taxes can make it a better deal for average and below average income earners to have the government provide it and pay for the services through the tax system. And I went through some cases in class showing you why that might be true. And today we're going to talk about a type of private service that's very widely provided by governments, namely various kinds of tax-financed insurance. Okay, insurance is inherently a pure private good. You either get the insurance reimbursement or you don't. Somebody sends you a check or not. Somebody pays for the service or not. Somebody reimburses you for the loss that you personally bore or not. All these are characteristics of a pure private good. So from what you might call mainstream public economics, for the most part, these types of services would not be provided. There's no particular reason why most of them cannot be provided through the private sector. Competition in the private sector tends to keep production costs, administrative costs down, and so on average tends to give consumers a better deal than they would get from a service provided by the government, even if the government is reasonably efficient at providing the service. And it's simply because governments have weaker incentives to control costs and weaker incentives to innovate and to kind of provide service to their customers, so to speak, to their citizens. It's not that governments don't provide those services. It's just that if you think of, say, the Department of Motor Vehicles in the United States, most of those places are fairly inefficient in the sense that they make customers wait quite a long time. It took them, for the most part, quite a long time to adopt websites for delivering the services that can be easily delivered over the internet compared to, say, other services like, say, Amazon's massive sales of goods and services you can buy through their website. So there are reasons to think that, well, in many cases you would be better off if the government provided, as the private sector provided the insurance. Although there are cases where the private sector will not tend to insure some kinds of activities. So let me just mention a few of those. First, so there's the case of night and uncertainty. Okay, insurance companies are well equipped to deal with what Frank Knight called risk. These are situations where there's some kind of probabilistic or stochastic process that generates outcomes, and where the probabilities can be known pretty well in advance of the activity. All right, so in that case, pooling risks can be done fairly easily. And essentially the insurance company can basically charge you or a customer the expected value of the payouts every year for your premium. and and that premium will be adequate to cover all the payouts that were made during the year. Plus, the company will require some additional payment for administrative costs and for profit. So, as long as the risk premium that people are willing to pay for this insurance is larger than those administrative costs and some profit margin, there are gains in trade between organizations that pool risk and individuals who want to shed risk to such companies. However, in cases of what might be called uncertainty, these probability functions can't be known very well. In fact, they may not even be probability functions, they must be kind of just things generated by the complexity of the universe. And in cases where that probability function can't be known well, the companies can't stand up and provide insurance because they don't know the probability of the losses. And so they don't know how much to build in the way of reserves. They don't know what their average payoffs are going to be, or payouts are going to be, and therefore those sorts of products tend not to be provided. An example of crisis insurance would be something like what happened with COVID-19. The federal government intervened in a way they thought was necessary. It's debatable, of course, but nonetheless, they intervened in a way that imposed financial losses on broad sectors of the economy. Some of those losses would have been borne anyway as people adjusted to the transmission process for that virus. But many were kind of the result of the regulation of behavior that was undertaken for the first couple of months of this pandemic. And the government borrowed trillions of dollars to pay people, try to compensate and reduce their losses associated with this series of public policies that were aimed at reducing the spread of the virus. So that's a one-off event. Insurance companies couldn't be expected to anticipate the virus or the government's response to the virus, and they certainly could not have created a reserve large enough to mitigate those losses. And then consumers probably would have been oblivious. They would not have recognized this possibility, or thought it was so faint and the insurance so expensive that they just wouldn't buy it. All right, so what you might call crisis insurance is one of those things that governments provide. It's not a true insurance product, but it's like one in the sense that it tries to compensate people for their losses. And in this case, it's funded with taxes or borrowing, or a combination of the two. Another type of insurance that insurance companies don't like to provide or they would charge a very high price for, is coverage over what you might call correlated losses. Kind of things that insurance works best for is there's some kind of low probability event that's kind of spread out all over the place, and the individual events are basically independent of one another. And the losses tend to be predictable year in, year out. On the other hand, if you have a process where there are losses that are that occur in kind of massive quantities and an irregular pattern, it's harder to figure out what the reserve should be, and so it's harder to sell an insurance product for those things. So if a hurricane wipes out a city, as happened with Hurricane Katrina for New Orleans, the losses for that kind of insurance would have just been a massive, a non-trivial value. The entire city was wiped out. And for an insurance company to be able to cover that, they would have to have, lots of cities that are in situations like New Orleans who faced similar risk of catastrophe. But there aren't that many cities like that. New Orleans is mostly under sea level, and so it's very dependent on its network of dikes pumps to survive even minor storms and less powerful hurricanes than Katrina. So they just can't cover those correlated risks very well. Okay, that's again has to do with the ability to kind of pool risks. There aren't that many risks to pool in a sense, and aren't able to cover them very well. Okay, it's not to say that it's impossible, it's just to say the insurance would be most likely quite incomplete and quite expensive. Another type of risky setting that's difficult for the private sector to cover involves risk patterns that are normally distributed. So a normal distribution goes from positive infinity to minus infinity. It's unbounded. And so if you provide insurance for an unbounded risk, you have to be prepared to make infinite payouts. You can't make an infinite payout. It's impossible. Okay, so the way you protect yourself from that, if you want to stay in business, is you create bounds on how much you'll reimburse for various kinds of losses. And so those unbounded losses would include these kind of correlated losses that I was mentioning before, where the meteor strikes and wipes out a city, but it also includes any pattern that plausibly has a normal distribution associated with it. Now, of course, the government can't provide an infinite payout either. So in the sense that in this type of environment, completely full coverage is impossible. But on the other hand, the governments can use the tax base, assuming they haven't tapped it all out at this point, to come up with the money, either in the long run through by borrowing and then paying off the loans, or in the short run just by putting together a fairly large reserve for these kinds of insurance programs. Now, with respect to providing a before the event reserve, that's something that governments aren't very good at, actually. They tend to not do that, and not as well as private insurers do, partly because the private insurers are all subject to a lot of regulations that kind of force them to do that. Okay, so there are these three settings where there might not be an insurance product available in the private sector that would satisfy consumer demands for it. And consumers who want more insurance would lobby the government to try to get them to take on this task and provide that kind of insurance that's missing. And so these kinds of cases are plausible, but actually the kind of insurance that governments mostly provide, health insurance, retirement funds, unemployment insurance, things of that sort. Some of these have kind of correlated risk, but for the most part, these are phenomena that have pretty well-defined probability functions. And private sector firms have been providing these kinds of insurance products for at least a century. So the types of insurance we actually observe, for the most part, we do see this crisis insurance quite often, at least for the past 20 years or so. But the mainstream day-to-day type of insurance that government provides, basically health insurance, unemployment insurance, and private pensions, tax-exempt pensions. And we do see that, sure enough, private sector provides all those types of products. So you might say, well, why then do we observe that some of these normal insurance types of products get sold or provided through the government? That is, you pay a tax price rather than a subscription fee for the insurance. Well, a couple reasons. The most likely is simply that because of the progressive nature of taxation, that a lot of taxpayers find that they get a better deal from the government, even if the insurance isn't quite as good as might have been available in the private sector, because their tax payments are just a fraction of the cost of the program. So if you're financing a tax finance insurance policy or service using an income tax, people with below average income are going to pay below average prices for it, and people with above average are going to pay above average prices for it, and people right at the average will pay roughly what they would have paid in the market. So everybody else is paying a different price from what they would have experienced in the market. And so it's natural for people with above average income to generally prefer private insurance to tax financed insurance. On the other hand, it's also natural for people with below average income to favor tax finance insurance over the normal market provision. They simply get it cheaper. All right, so the simplest explanation in a kind of voting model is that the median voter finds that tax finance insurance is a better deal for him or her than purchasing the same insurance or similar insurance in the private market. Okay, well, on top of that, sort of simple pragmatic explanation, there are also ideological explanations. So if people actually believe that they would be better off buying the quantity of insurance that they actually liked or wanted rather than sort of the standardized package that the government provides, they would opt for the private sector type of insurance rather than the public sector, simply because it might be cheaper for them. They might not want as much insurance as the government is going to provide, and therefore they would be better off with the private insurance, even though there's this implicit subsidy through the tax system on the government-provided insurance. So there are cases where even where you get a better price from the government's going to provide too much, and you're better off with less insurance, and you would opt for that instead of the more expensive, larger package of benefits that the government provides. So it's not a clean hill. It's not necessarily the case that every time you see an insurance product that's going to be provided by the government, if there's a demand for it. But there certainly are cases where that's the driving force behind the adoption of tax finance insurance programs. So in a way, the most obvious of these is probably the tax finance pension programs, which are kind of like tax finance annuities, which annuities being a product that many insurance companies provide and sell and profit from. It's clear that people with below average income get a better deal on the annuities that are provided by the U.S. Social Security program than they would get if they had to buy the same product from the private sector. Besides which, they don't have to worry about the private firm that they buy the insurance from going out of business, right? Whereas the government is pretty safe, and it's probably not going out of business. And so that insurance policy, that annuity from the government is not only cheaper, but it's lower risk for most people, the majority. In terms of health insurance, things of that sort, in the U.S. we have this kind of peculiar system where we have tax finance health insurance for old people, and we have tax finance insurance for relatively poor people, and everybody else gets insurance one way or another through the private sector. So it's a mixed system. It's quite expensive, as it turns out. We spend almost twice as much on our setup as most other countries pay on their socialized tax finance healthcare systems. Which is, so that's an oddity for our U.S. system. Most other countries have a setup where the bulk of healthcare insurance and healthcare per se are provided one way or another through tax finance programs, with some possibility of topping them up by buying private insurance at the margin. Okay, so what's going on there in the U.S.? I would say probably it's an interest group thing, and we don't have a haven't talked about interest groups yet in this course, but you can see that our system, of course, makes everybody in the healthcare system better off. They're all earning higher salaries, having better facilities to work with, and so forth than what would exist if we were spending only half as much on healthcare. I think that's pretty clear. Obviously, if you're a medical professional, you work in the drug companies, you build hospitals, all these different groups have financial stakes in keeping our system at the high end of the cost structures that we see in the world today. So if we go back and think about the basic geometry of the purchase of insurance, we can first see that it's a consequence of diminishing margin utility. If you have two outcomes, a good outcome and a bad outcome, this could be healthy, sick, and with some probability of being sick, then if this is the expected utility of that particular disease or illness, which reflects the probability of being sick and the probability of not being sick, and right above that is the utility of the expected value. Right? If you took the average outcome of illness for this value, this would be VE. If you had this result with certainty, you would be up here on a higher at a higher point on your utility function than you are down here at the expected value. When you deal with financial risks, okay, you do have the option of coming up with a deal where you can kind of basically pay someone else to take the risk, and you get the certain payment instead, this VE amount every time, in which case you'd be on this up here on the utility function rather than down here on the expected value line. You can't really do that with health, by the way, because you either get sick or you don't. There's no kind of certainty equivalent. You can't have half a broken arm or half of a medical procedure. But for anything that's involving financial losses, this diagram is relevant. And if you go over here from the expected utility to the certain utility that's equivalent to that, you can see that that implies a value here I've called VIND. That's the value that you'd be indifferent between a certain value of this amount and the risky value that's of this phenomenon that's generating this expected utility. And the difference between VE and VIND is your risk premium. That's the amount that you'd be willing to pay to avoid the financial risk. And so that risk premium has to be high enough for insurance companies to be able to offer your product and make money off it. They have to kind of profit from this, at least earn the normal rate of return on their investments in all the administration, hardware, and people involved. But in many cases, there are gains to trade between individuals who want to shed risk and insurance companies that can kind of pool risk and through the pooling process basically really reduce their risk phenomenally. The distribution of a sample mean, which is kind of what the insurance companies work with, falls directly in proportion to the number of subscribers to the insurance. And so if you have 1 million members or subscribers to your insurance product, the company is basically almost guaranteed to pay out VE every year. Something really weird has to happen for that VE numbers to get changed. So that number plus their administrative costs would be their kind of bottom line, the lowest amount that they could accept for the insurance. And as long as P, this risk premium distance, is larger than that amount, there are going to be gains to trade between folks like this and others who might be even more risk averse than this person and the insurance company or the government, depending on who's providing the insurance. So what I've developed today so far is that there are at least 3 cases where markets will not provide the kind of full insurance that consumers might want to purchase at a price they're willing to pay, but where persons who have below average income might find the discount price they get through the tax finance insurance to be worth their while and be happy to pay for it, even though the insurance program itself may not have positive net benefits for everyone. Their subsidy is indirectly paid for by the people who pay higher prices for those services, namely people who have above average income and or below average risk. And when we think of kind of ordinary insurance, where the probabilities are pretty well known and pretty well behaved, governments would take those on basically mostly for this practical reason, for the income tax-based discounting that people with below average incomes receive when they buy insurance through the government system, or some kind of ideological or altruistic impulse, where they're concerned with people having too little insurance, where too little is relative to their own idea about what the ideal insurance level looks like. Right? So, given a kind of a typical distribution of income, people at the low end are going to buy less insurance than people at the high end. And so people in more or less the middle of the distribution, where the median border is, thinks that's too little in some sense. They may, for ideological or altruistic reasons, kind of push to get a program that provides them with a better deal on insurance, such as we have in the U.S. through the Medicaid program. Okay, so that program makes perfect sense as an example of voter altruism or ideologically driven programs that are aimed to kind of actually help a particular group rather than pragmatic interests and kind of getting the discounted insurance package that you might say motivates, say, Medicare, the program of health insurance available to retired people. So some combination of these pragmatic versus idealistic rationales for tax finance insurance is most likely for common insurance products. And since those common insurance products are the sorts of things that we spend the most money on, it's very likely that those two rationales account for the basic overall structure of the tax system that we observe. Now, in the notes that go along with this talk, I go through the mathematics behind Insurance Club and talk about factors that determine the viability of an insurance club. It turns out that there weren't a lot of private insurance clubs during the 19th and early 20th century before the U.S. started to get involved in various insurance-like products such as unemployment insurance and Social Security, and subsequently Medicare and Medicaid in the 1960s. And so these clubs have almost disappeared, at least as far as insurance is concerned, and that's because they can't really compete with these tax-financed systems. So with that, I'll stop for today. Take a look at the notes that go along with this block of material. The mathematics are interesting, fairly straightforward, but I decided not to talk about them today since the math is already worked out in the notes. And instead, I talk more about what types of insurance that you can't get in markets and types that you can get in markets. And I'm basically arguing this talk because so much of what we observe for tax-financed insurance programs are actually examples of fairly ordinary types of insurance where risk can be calculated. That what's going on there must be a combination of these pragmatic tax discount type of interests for people with below average income and idealistic or altruistic or ideological ideas that tend to encourage government provision of these services. And you can see that in the data if you look across the various healthcare systems in the OECD countries. So that I'll stop and I'll be back with another lecture shortly.